Hey y'all, it's Richard with Matthews Wealth Management here at church. A little pop-up situation. They had a cool TV and got the lighting and everything set up. So we're going to play a little catch-up, cover January, February for Fed and M2, right? And so yeah, I don't have such great news this time, but quantitative tightening with what's happened in March already is kind of going to die, I suppose. We'll see. It's a weird time. So let's just jump in. We're going to cover from Fred. If you ever want to look this stuff up on your own, it's really easy to get to. But if we go back to all history of M2, which was recategorized as M2SL, redefining things in our world seems to be the only way to answer questions. But here we go. That was TARP and bailouts, and man, we all hated that. That was not fair for the banks to be bailed out. Lo and behold, over the weekend. Anyway, COVID, right? We did this monstrous $6.5 trillion of printed money, counterfeit money. I'm going to start just calling it counterfeited money, because if I do it, I go to jail. But if the Fed does it, it's all good, right? Anyway, so we're tracking how many dollars are out there. That's the long-term picture and how insane we've become. So let's zoom in. All right, so we've got January of 2020, and then all the printing that went on, and we can see, cool, it's starting to come down on M2. What was that? Uh-oh, wait till we look at the numbers. M2 is supposed to come down. Nope. We gave up, guys. And not a moment too soon, I suppose, with how the banks have already had issues with mark-to-market accounting. You know, I wanted to say this in my SVB video, but if we did a mark-to-market accounting on the Fed balance sheet, they'd be insolvent too. And what are they going to do? Print more money? Well, that's debt. So where are the assets? Oh, we got a problem. But don't ask those questions. Those will get you in trouble there. Anyway, we're at $21.267 trillion that are floating around out there for all of us to work for and then spend and pick up goods that cost more. And this is where inflation comes from. Duh. If you've watched these, this is broken record time, but come on. So one month ago, it was 21.236. So you can see there was an increase there of roughly $30 billion of free money that floated around. Now, I'm not going to blame the Fed completely on this. Actually, hardly at all. The Fed's, man, they're stuck. They deserve it completely. But yeah, I'm not going to blame them for M2 going back up. You'll see where that comes from. Year to date's the same thing because, you know, January, February here. From a year ago, however, M2 has dropped 1.72%. So everybody calling for a pivot. A pivot by the Fed is they're looking at inflation, core PCE and CPI and PPI and all that good stuff. They're also all confused about how unemployment works with inflation. So good luck reading that one. However, with this negative on basically unprinting money, which is a good thing, they are going to get the indicators they want in CPI and core PCE to be able to say mission accomplished. So that's good, right? So we've stopped printing, which will stop inflation from continuing to trickle at some point. Is that a 1-year deal? Is it an 18-month deal? Is it a 36-month deal? Yeah, you can't predict how long it takes asset value to translate into expense and circulation. So anyway, that's a good thing, but we've now quit. We've gone backwards. So since January 1 of 2020, we have printed 38% more dollars than what existed before. And again, if you want to read inflation, look at all the different things since January 2020. They should, on average, all get to 38% now, right? So if we actually want prices to come back down and be transitory, yeah, did you really know what that meant? We're going to have to unprint this much money, or, you know, the difference between here, so roughly 6 trillion, we'll have to unprint, and we've done 1.72% of that. So, yeah, got 99 years to go, I guess. All right, so let's jump into the balance sheet. Oh, that skipped really quickly. I like this. This is helpful, right? Like just what happened, right? And we just track this thing from under $1 trillion. And then we have the crash of 2008, Great Recession. And this was TARP. This was bailouts, right? This was the money that and actually all of the mortgages and bad debts that the Fed bought, which kind of also is the same thing that just happened, FYI. Bad debts that they had to buy up, right? Are they going to buy up the bad treasuries? That's funny. Oh, that's cool. Yeah, I'm going to talk to some people about that. Maybe that's what the Fed does next, is they go from um, whatever. Sorry, rabbit hole. So this all continued. We had to keep buying bad mortgages all along the way, and we had built up to 8 trillion roughly on the balance. I'm sorry, 4 trillion on the balance sheet. And then they tried this in 2017. We're going to do some quantitative tightening, guys, because this is quantitative easing, right? All the different QEs, QE to infinity. And then we said, let's try a QT. Nope. COVID. COVID was the bailout, guys. I mean, if the banks ever needed a pandemic to come around, it was probably right around here. I got it. So, yay. All right. Fed just, they bought as many treasuries as the U.S. Treasury wanted to. That was PPP. That was, even up to infrastructure and so forth. All of these purchases was immediately monetized debt that, because we don't pay enough in taxes. Nobody does. So we spend way more than we take in. The difference is debt creation, and debt has to be sold to somebody. Well, nobody wants to buy treasuries, especially after the weekend. But yeah, so this was just money printed out of thin air, and the Fed had to buy up all of the excess debt that the U.S. was creating, right? And so all this goes up until time to start selling off the balance sheet. Cool. I'm excited about that. And look at that. That's real. It didn't stop the way we just looked at M2. It continues. The Fed's actually doing something good here just in time for the SVB thing. So let's zoom in. Yeah, so here's the spike and then all the different purchases, and then cool, good. That's what, I'd like a steeper slope, but hey, it's the right direction as opposed to M2. So let's look at that. We're at 8.3. We were 8.4 a month ago. Well, these are on a daily, by the way. M2 is on a monthly. That's why I'm able to show a different year-to-date. Year-to-date January 1 as opposed to January 31. So 8.5, 8.4, 8.3, we've unprinted, or they've sold 2% off of their balance sheet, which should have destroyed 2%, but it didn't. In the last month, they have sold 1.1%. Well, what did we just see on M2? A plus 0.15. What's up with that? I'll tell you in a sec. Last year, they've sold off 6%. Good job, guys. It's a lot more years before all that's done. Was that like 18 years or something? Before they've actually sold that back off. We're just under doubling what our mortgage bailouts were. Okay, so like we ran up 4.1 trillion. We're just under 100% of that. So I don't know how and when they're gonna. This is just COVID, right? And this is mortgage. So what's a realistic number that the Fed should have on its balance sheet? Because they're the lender of last resort, right? No, they're the buyer of last resort, is what's happened, right? Our financial system is not what you think it is or should be. Money is simple. This kind of crap makes it hard. This kind of crap shouldn't exist. Okay, so that's my core takeaway that I want to leave with everybody. So let's get into the disparity between this 1.1 negative and then the other positive 0.15. So the balance sheet, they sold off 165 billion of treasuries and mortgages, a couple of high yields here and there. M2 went up 30 billion. Why? Fiscal. What is fiscal? Fiscal is congressional spending. That's what we decide to spend. I don't know, Ukraine, maybe? We haven't done the student loan thing yet, but all this social spending, man. I'm all for social safety net, but it shouldn't be more than the productive capacity of the economy. But we've done it. So how does this, everything the Fed's trying to do, Congress is undoing and then some? I don't know, man. I'd hate to be Jay Powell. Number one, he's not doing what he believes in because he doesn't work for himself. But everything he tries to do, they undo, and then he gets yelled at for it. So I don't know. I'd probably quit because we're at that point where things hit the fan, and you're the one that caused it, as far as average Americans believe, because this stuff's hard, right? Um, and it is hard. I mean, I'm not going to act like everybody should understand this stuff, but the core takeaways are that it's intervention with this kind of stuff to be able to print money out of thin air. That's what ruined every empire, right? Debasing of the currency. And when it was in physical gold and silver, they'd confiscate it, melt it down, add some tin, and send out some coins and keep some, right? That's a very expensive process to counterfeit. This is free counterfeiting. They do it digitally. Central bank digital currency is this to an infinite power. I hope to God we never have to deal with that. I think everybody's smart enough to know, don't give them literal control of money. In fact, real money is owned by, earned by, produced by people. Government should have no say-so in this stuff, in my opinion. So let's get all this kind of stuff out of it. Let's get back to a balanced budget. Make them continue to do what they're doing, because the Fed's trying, at least, and they're not going to be able to raise rates just because of interest rate risk, which we've talked about, and apparently nobody understood, especially from Dodd-Frank. So yeah, that's my rant, I suppose. The numbers that we've uncovered: Fed good, Congress bad. Big surprise. Well, that is a surprise, but anyway, wait around till March, because that's going to be a even weirder one, where we'll see how they shift. I think that's the next step, right? They're going to start buying these treasuries that are now considered bad debt because they don't pay enough interest. Told you so. All right, with that, I'll end it. See you in March.